Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and I know a lot of you have been waiting for this show in particular simply because we've talked about a few topics that we will talk about, and we'll do that in just a bit. But what is also very, very pertinent from a market's perspective and from an investing perspective is what to do with the fixed income investments in the current scenario when when yields are moving up across the world. They may not continue to move up, but nobody knows that, right? So in light of the fact that the markets seem to be pricing in a period of rising yields, what could happen, if at all, to your fixed income investments? So I think we'll talk about that with two experts, Mr. Mahendra Kumar Jaju of Mirae and Mr. Vijay Mantri. Of course, he's been on the show so many times, needs no introduction. And we'll also talk about an NFO that Mirae is launching today. So just a brief chat on that. And then, of course, we'll continue with the conversation with Mr. Vijay Mantri on a host of other things, including how can NRIs access the Indian mutual fund market. We'll, of course, talk about why does it make sense, if at all, to move into active funds. And Vijay Mantri is going to speak about the DSP Natural Resources Fund and why does his firm believe it's a good fund to invest in. So lots of things to speak about over the next 20-25 minutes. Gentlemen, both of you, thank you so much for joining in. Mahendra, let's start off with you. Thanks for joining in. Rising yields across the world. There's equity markets seem to be baking in some fluctuations and some multiple corrections because of that. How should an average mutual fund investor in the non-equity side think about this phenomenon? Mahendra Kumar Jaju, this question is for you.
Yeah. So the global bond yields are moving up in anticipation of the inflation coming back into the system. The difference this time, unlike the last 10 years where the excess liquidity in the global system was largely a function of the monetary policy-led quantitative easing, this time there is a huge fiscal expansion. Even the conservative countries like Germany and Singapore have 20% fiscal deficit. So market is expecting the bond yields to go up in anticipation of inflation. Also, in the last Fed meeting, the Fed did not, endorse the market's expectation of extending the maturity of the bonds that it is buying under the quantitative easing program. So there is a little bit of a sharp rise in the bond yields globally. As far as India is concerned, overall the global monetary policy setting is favorable. For whatever it is worth, the headline inflation has come to close to 4%. So I think that gives the Reserve Bank a little bit of extra elbow room to keep the interest rates rise under check for now, given that the economic recovery is still nascent in nature. But the weight of the large government borrowing program and the fact that the corporate rate will pick up going forward if the economy is to grow at 10% plus, so there will be a bit of a crowding out of the corporate borrowing program. It is possible that in the second half of the year, we will see the rising yields. Now, when the yields are rising, obviously the investors will factor in as to how their debt investments can get affected. And needless to say that when yields go up, there will be some adverse impact on the NAVs. But for people who are long-term oriented in nature, who are willing to sit through one complete interest rate cycle, I think they just need to wait it out for long-term benefit to have the tax advantage, etc. So, like in equity market, when it corrects, we say it is an opportunity to buy because the valuations have become attractive. We look at the fixed income in the same way and say, look, if you think that yields are going up, it is an opportunity to buy new bonds at a higher yield, especially when the corporate rate demand is expected to pick up. The large good companies will be borrowing at higher rates because their business is growing. So all in all, there is an opportunity to not look at it in a negative way, but as an opportunity to buy in correction. That's how we look at it.
Yeah, I've muted myself so that the audio is clear. Vijay, can you comment on this? And it'd be great if you have a view which is maybe not necessarily completely confirming. What is your view here?
So I think, Neeraj, you know that we have been consistently saying that the interest rate in global market and India will go up. And in the beginning of the year, not we said that is to invest in the lower end of the curve. Now we have seen the interest that has moved up in 10-year GSEC from 570 to around 620 in between, which is a 50 basis point move, which is I think very, very decent move. So I think if one is looking at 2 to 3 year horizon, perhaps this is the starting point to look at corporate bond and interest sensitive debt fund, but in a very gradual manner, because the best time to invest in debt funds when the returns are looking negative, not when the returns are looking positive. It is very discomforting when you start investing, but I think that's the best way to look at investing in the bond market. So one can start making very small exposure in the corporate bond fund. An advantage Mirai perhaps would have is that they are starting now. So in the beginning, the portfolio duration will remain short. They will get new money, which will get invested at the higher interest rate. So one could look at start with a small allocation and then see how the interest rate move and then take a call on periodic basis. As you understand that interest rate calls are much more difficult to take than the equity market calls.
Oh, for sure. But actually, which is why, Mahendra Kumar Jaju, it's an interesting time that you guys are coming out with this NFO. Vijay referred to it. So since we brought it up, can you talk a bit about this? What's the rationale of launching this NFO? Why this current time? And what kind of investors should apply to these funds or to this fund? Mr. Jaju, the question is for you.
Yeah, can you just repeat the question because I lost your voice in between?
Yeah, I was asked. So
line was not very
Vijay Mantri just spoke about briefly about your upcoming NFO. Can you talk a bit about that? What's the rationale of launching the NFO at the current juncture? What kind of investors should apply to the NFO? What kind of returns can be anticipated? About your NFO, Mahendra Kumar Jaju, can you talk a bit about your NFO?
So I still don't have the audio line very clear. So I assume you are asking about our corporate bond NFO and why it is a good time to invest in that, right?
Yes.
Because in our view, the government borrowing program is rather large, and the expectation is for the economy to grow in double digits, which means at some stage the corporate credit demand will pick up. Right now, we have a lot of excess liquidity in the system as the corporate credit demand picks up, and a lot of this liquidity will filter through the broader economy, which will cause a bit of inflation. The higher borrowing will put pressure on the bond yield. So, in the next 6 months, we'll possibly see a situation where, because the business is growing, large, high quality corporates will be there in the market to borrow at attractive yields. So that sets a good ground for building up of a good high quality portfolio. Obviously, the best opportunity to build a portfolio when there is good supply at attractive valuation. So from that perspective, we think that it's a good time. In terms of the credit quality of the portfolio, we look to restrict ourselves to high quality credit, AAA, AA plus bonds, and to some extent government bonds and T-bills to manage liquidity and the duration target. So all in all, this looks like a very good opportune time for start building a portfolio in this kind of a fund.
Okay. And what are the risks to an average investor, Mr. Jaju?
So there is always a risk of a short-term volatility or depressed returns, because obviously when you are buying at a time when the yields are going up, obviously there is a short-term concern that for a while the returns may look negative. But as I said, that we have to look at it in terms of the market cycle. So therefore, we have seen historically, and I think Vijay was also saying the same thing, that the time to start building the portfolio is when the yields have gone up, and we will be investing in our fund in a gradual and incremental way, assessing the market condition, because we follow a flexible interest rate strategy where we look at the valuations appropriately before we start, chipping in from the market. So the risk is primarily of interest rate volatility for the period during which the interest rates may tend to inch up. In terms of the credit quality, we are going to focus on the high credit quality. So I believe that the risk is largely for the investors to be prepared for a bit of a patch of volatility. Beyond that, I don't see it as a risk, but a good opportunity to lock money for long term at higher yields.
Okay, we'll leave it at that. Mahendra Kumar Jaju, thank you so much for joining in and giving us your thoughts. And all the best with the NFL.
Thank you.
All right. Now, Vijay, you briefly spoke about why investors might have some gains because they will invest at the higher end of the range, etc. But purely, I mean, just from a perspective of somebody is looking to invest in these kind of funds, is the Mini NFO a good option? Or are there other options, or do you think there are better categories than the current category that is being on offer?
See, right now, most of the money has to be in the lower end of the curve. So perhaps liquid is the best category right now because month of March is coming, and the month of March interest rate generally goes up for various reasons. So even if someone want to take exposure to ultra short term, the best time to look at the first or second week of March. And then one need to look at the interest rate very, very closely because the commodity price has gone up. Soft commodities, hard commodities, oil, everything is up anything between 50% to 100%. So there's no reason that interest rate would remain at the same level, at least in the global market. In Indian market, the interest rate has not come down that dramatically. So rise will also be very limited in my opinion. So if one is looking at building the corporate debt portfolio, perhaps start looking at biting little bit. You are in the first leg of the journey. So over a 6 months to 12 months will be fantastic time. If you are looking at building the book on the debt side, the next 6 to 12 months may provide interesting opportunities.
Okay, Vijay, didn't I see a tweet from you which said that liquid funds might not be the best option? FDs might give you a better rate, better return.
Yeah, not FD. I said saving accounts. If you get 4% saving account, interest rate in the liquid fund is 3.25%. So it doesn't make any sense for whatever reason. If you're able to get, if you're an individual, and if you get anything about 3.5% in the bank deposit, keep that money in bank deposit. You also get separate reduction in the income tax act up to 10,000 rupees interest every year. And what is most fundamentally interesting thing to see, suppose you want to invest money from liquid fund to equity fund. If you do it today after 1st February 2021, then you get NAV of the next day. But suppose your money in a bank account, then you can get the NAV of the same day. So it makes tremendous sense not to keep money in the liquid fund, the money which you are keeping to park in the equity on the timely basis. If interest rate in the economy goes up and liquid fund start delivering 4% kind of return, that perhaps is the time to look at owning liquid fund, not in the current environment, because in current environment, your saving bank suppose offer you 3.5% plus, keep money there.
But compared to the funds on offer, the liquid might be a better option currently.
Liquid might be a better option, and you look at in the month of, invariably every year in the month of March, yield shoots up anything between 25 basis point, even to certain extent, 1% on the shorter end of the curve. So take the advantage of that situation.
So for the very short term, maybe liquid funds might be a good option, but otherwise, Vijay is saying examine the returns in your savings account versus a liquid fund and then try and go for it. Well, very rarely do I hear.
I never thought I would say that.
That's what I'm saying. Very rarely I hear you talk about that. But anyways, Vijay, there's a lots more to talk about. So let's quickly move topics and try and cover some of the other things. As we all saw, or as we both saw, there were a couple of people who inquired very recently about, what can NRIs do when it comes to investing into mutual funds. And there have been queries throughout the year. So can you just very succinctly, Vijay, tell us what are the options available for a non-resident Indian to invest in the Indian mutual fund landscape?
They can invest in all the mutual fund. There are few mutual fund which take money from citizen of US and Canada, and not everybody take money from citizen of US and Canada. The list has been given. The investor can examine. Beyond that, they can invest in all debt, all equities, all kind of investment option. However, I recommend they not to invest in the international fund, because if somebody is sitting in US and want to invest in a feeder fund which invests in other country, they take additional currency transaction cost. So if you are in India, if you are in outside India and you want to invest in Indian market, Indian mutual fund provide best opportunities. But if you are an international market and want to invest in other international market, don't come through Indian mutual fund route. So these are the various asset management company which takes money even from the residents of USA and Canada. Rest of the countries, all mutual fund take money from the rest of the countries.
Okay, so you are saying, Vijay, that these 8 funds on the screen will also take money from residents of US and Canada, but
Yes.
otherwise all funds will take money from all NRIs. No issue at all.
Absolutely. Absolutely. No problem.
This applies to the debt category as well?
Yes.
Okay, so both equity and debt investors, people can apply to all of these funds.
Not only in mutual fund, NRI could invest in real estate, they can invest in PSU bond, they can invest in direct PSU, debenture, NCD, perpetual bond, FDs, anything.
Okay. Are there any risks that an NRI investing in an Indian mutual fund should be aware of?
Yes, there are a couple of things they should know, they should be aware. One is that the taxation part, they need to be very, very clear. One is that first they need to figure out whether the scheme in which they are investing is a debt-oriented scheme or equity-oriented scheme. It is very important. And it's very important to know that equity-oriented schemes are a scheme. The underlying fund invests in Indian companies only. So what does it mean? That all fund of funds are not equity scheme from the taxation perspective. They may be equity scheme from the risk perspective, but they are not equity scheme from the taxation perspective. So first thing to examine that whether the underlying scheme is debt oriented or equity oriented. Once you do that, then figure out whether your investment is short term and long term. In equity, short term is 12 months, below 12 months, and long term is about 12 months. And in fixed income side, 36 months, below 36 months is short term, about 36 months is the long term. So keep the taxation in mind and also keep exchange rate fluctuation in mind when you're looking at investing as an NRI into Indian mutual fund industry. And here the below chart very clearly tell you what is the tax rate. If you are owning equity or equity oriented fund, then tax rate below 12 months is 15% plus surcharge, which depend on what is your taxable income in India. If your taxable income is below 50 lakh, no surcharge. If above 50 lakh to 1 crore, then there's very slab available. And long-term capital gain tax on equity-oriented mutual fund about 12 months is 10% plus surcharge plus 4% cess. So invariably what happens that fund house generally take for a long-term capital gain tax, the tax is just below 12%. So just keep that in mind when you are investing in the equity-oriented mutual fund. But when you are looking at investing in non-equity oriented mutual fund, keep in mind anything below 36 months, it is a marginal tax rate. It means that whatever is your taxable income in that financial year in India, your mutual fund gain on the fixed income side will keep added there, and whatever the tax slab you fall in, that is a tax applicable to you. But mutual fund invariably will deduct 30% tax on your short-term capital gain and deposit with the exchequer. You as an investor can claim, suppose your tax outgo is lower. When you look at long-term capital gain on the fixed income side, which is about 36 months, there are two categories one need to keep in mind: listed debt fund and non-listed debt fund, unlisted debt fund. What are the listed debt fund? FMPs, capital protection oriented fund, and most close-ended fund except ELSS are listed. So for them, the taxation is 20% plus indexation. Unlisted means all open-ended debt funds are unlisted. In those category, your tax liability after 3 years is just 10% on the capital gain, and then you have to pay surcharge or cess depend on the taxable income in India. So it is a very simple and straightforward taxation. What is applicable to most Indian investor is applicable to NRI. They just need to be mindful of foreign exchange fluctuation when they invest in Indian market.
Yeah, that was the additional point that I was going to make, that the forex risk would be from the investor's perspective. But okay, so Vijay, this helps. Viewers, please keep in mind, this is a very simplistic, a comprehensive one, but a simplistic guide of sorts if you want to invest into Indian mutual funds. Do consult a financial advisor if you want some more information, because not only the timing, but the choice of funds, the taxation because of the long term, short term, etc., would all be applicable case to case. So please keep that in mind. Okay.
And it is very important factor which I didn't want to elaborate, but one need to keep in mind is a foreign NRI when they invest in India, they take benefit of foreign exchange fluctuation in their taxation. But it's too complex a subject to explain your TV show. Any of your viewers are interested, they can DM me on the Twitter. We can answer, or they can write on the YouTube. We can answer all the questions they have about the taxation.
Yeah, that's fair advice too. So viewers, well, that's an offer. You can DM Vijay, you can write on the YouTube chat, you can write on the Twitter chat where we have posted this show, or Facebook for that matter, and maybe Vijay will try and, or Vijay's team will try and respond to some of those. Okay, let's move on. Now, Vijay, we had asked you about a fund that you may believe investors should either look at very seriously or get out of because that fund may not be doing well. I reckon you choosing a fund because of the category and not necessarily only because of that fund. Can you talk a bit about this? I think that the choices between from moving out from SBI
index funds too. See, what we saw that if you look at data on December 2020, most of the large actively managed large cap has underperformed Nifty TRI. But in the mid and small category, the outperformance has been significant by the actively managed fund. So if the same fund house could outperform in the mid and small cap, then why they can't outperform in the large cap? So if you deep dive into data, we figure out the most important reason has been that in the Nifty, the contribution of top 5 stock has been very, very high. So if you look at data for 2018, Nifty top 5 stock contributed to 152% of the Nifty return. Now, an open-ended mutual fund can't own more than 10% in a single stock. By default, they can't own more than 50% in even top 5 stocks. So the reasons were structural because market was a very narrow market. From 2018 to 2020, only 2 stocks, Reliance and Infosys, contributed to 66% of the Nifty return. So the market was very polarized because GDP growth was not happening. The money was going on to few stocks. Now, post this lockdown, the economy has become much more broad-based. The market has become much more broad-based. So if you see data for last couple of months, very clearly, there's a decent outperformance by actively managed fund. So in my opinion, if the economy recovery become much more broad-based, then in any broad-based economic recovery, actively managed fund does much better job. So if you were a good luck to have you invested in the index fund in last few years, perhaps it is time to look at moving out from the passively managed fund to actively managed fund.
Okay. So it's not as much a call, Vijay, you're saying on SBI Nifty fund versus SBI actively managed fund. It is a category fund. But if people are invested in the SBI Nifty fund, you reckon that they could move into the
they can move to SBI large cap, SBI blue chip fund, wherever in various fund houses. My call is to move money from the index fund to the actively managed funds.
Okay. But, well, we can't let Vijay Mantri go without talking about a fund, right? So let's talk about that. And let's talk about the fund house or the fund that you've chosen, Vijay, from the DSP stable. Now, what's the story behind this? Why do you like this? What kind of investor should go for it? Give us a lowdown.
See, if you look at last couple of years, we have seen only growth investing and the interest rate has been coming down. Now, the important question to ask ourselves is what will happen if the interest rate has to rise? If interest rate has to rise, then commodities will gain significantly. So this DSP Natural Resources and Energy Fund invests in commodities company, it invests in oil, it invests in gas, it invests in alternate energy. So my top pick today, definitely one is value investing and one is DSP Natural Resources Fund, which has a holding in Tata Steel, Hindustan Zinc, Hindalco, Jindal Steel, NMDC, SAIL, ONGC and Reliance Industries. So if you have to play on interest rate rising, if you have to play inflation coming back, if you have to play economic recovery, then this is one of the fund which will do very well. We have started recommending this fund from September, October 2020, and it's done very well. And we believe that the commodity cycle is generally for a couple of years, not for 3-6 months. So for next couple of years, this fund can add significant value to the customer.
Okay. How does it stack up compared to other comparable funds, or you reckon that this is the best in
We
the
don't
category?
have this fund. Very interestingly, invests 1/3 of the money in the international market, where part of the money get invested in oil companies and part of the money get invested in alternate renewable energy. So it's a very good combination. What 2/3 is invested in domestic metal mining company. Out of 1/3 which they invest in international market, almost half goes into oil companies and half goes into alternate energy. So it's a very good mix of the portfolio this fund has. So we have been recommending this fund to our investors for last, I think, 5-6 months or so.
And what are the risks to this fund, Vijay?
Risk is that any commodity fund tend to remain very volatile. So keep that in mind. But if it remains volatile and the NAV goes down, don't worry. In past also, the fund NAV has gone down. You have to wait for a couple of years. But when the recovery comes very, very fast. You will make money in 5-6 months, which you waited for even a couple of years. So just be mindful of the volatility when you invest in this fund.
Last question and standard question, Vijay. These recommendations that you made, for example, the DSP side, aside of the fact that you would be recommending these to your clients, there are no other benefits that your firm or you yourself get from the DSP stable?
No, we are a mutual fund distributor. Definitely, we get commission from all the fund houses we sell our product. And in my personal capacity, I also invested in this fund. So there's a disclaimer you can make.
Okay, great. Vijay Mantri, really great having you. It's been a while, but good having you today. Thank you so much for addressing a very important topic, and stay safe.
Thank you. Same to you and same to your viewers as well.
Thank you so much, Vijay. And viewers, I hope you found this episode as useful as I found it to be. Thanks so much for tuning in today.